What if you could control a stock position without buying the stock itself? That surprising idea is where options trading begins. But options aren't magic, and they aren't guaranteed profits. They are contracts with specific rights, obligations, prices, and expiration dates. To understand them, forget complicated strategies for a moment. Imagine you're watching a stock currently trading at $200. You believe that stock could rise, but you don't want to purchase 100 shares for $20,000. Instead, there's another possibility: buying an options contract that gives you a specific right connected to that stock. And that word right is extremely important because an option buyer generally receives a right, not an obligation. A call option gives its buyer the right to buy the underlying asset at a specified price before expiration, subject to its terms. A put option works in the opposite direction, giving its buyer the right to sell the underlying asset at a specified price. Those two contracts, calls and puts, are the foundation. Almost every option strategy you'll encounter starts with them. Now let's return to our $200 stock. Suppose you buy a call with a $210 strike price. The strike price is simply the permanent price at which the option's contractual right can be exercised. But obtaining that right isn't free. The buyer pays something called a premium to purchase the options contract. Think of the premium as the market price of the option itself, influenced by several forces we will uncover throughout this series. The stock price matters, the strike matters, time matters, volatility matters, and together, these forces create constantly changing option prices. Now imagine the stock rises from $200 to $230. Suddenly, that $210 strike looks very different. But here's the important part. The option doesn't simply copy the stock's movement dollar for dollar. Its value depends on the relationship between the stock price, strike price, remaining time, volatility, and other market factors. These are the forces. And this is where options become fascinating. Two traders can correctly predict that a stock will rise and still get different results. Why? Because predicting direction is only one part of the equation. The timing and price paid for the option matter too. Imagine buying an option, but the move happens after your contract expires. Don't let timing defeat your perfect trade. That's the strange power of expiration. Unlike owning shares, an option contract has a clock attached to it. As expiration approaches, the remaining time becomes increasingly important, and that brings us to one of options' biggest concepts. It's called time decay. Later, we'll see why time quietly works against an option buyer. But there's another side to every options contract. If someone buys an option, someone else is typically taking the other side. The buyer pays the premium and receives the contractual rights. The seller receives the premium and takes on contractual obligations. That difference creates very different risk profiles, which is why options cannot be understood by looking only at potential profits. For a purchased option, the premium paid is generally the maximum loss if the option expires worthless, assuming no other position changes. But option sellers can face substantially different risks, depending on the strategy and whether the position is covered or uncovered. This is why professional options education starts with mechanics and risk, before jumping into strategies promising impressive returns. Now there's another question. What happens if your option becomes valuable before expiration? You don't necessarily have to exercise it. Depending on the position and circumstances, an option can potentially be sold before expiration, allowing the trader to close the contract. This distinction between exercising, selling, and allowing an option to expire becomes extremely important as we move deeper into options. And remember, standard U.S. equity options generally represent 100 shares of the underlying stock per contract. So a quoted premium of $3 can represent $300 per standard contract, before commissions or other costs. Suddenly, that small number on an options chain looks very different. and that's why reading the chain matters. Soon, we'll learn how strike prices, bids, asks, volume, open interest, and expiration dates appear inside that chain. Then we'll uncover the Greeks, delta, gamma, theta, vega, and rho, the variables that help explain option behavior. Later, we'll explore volatility, spreads, and strategies, position management, probability, and psychology, and the risks that can change everything. Because options trading isn't simply about guessing whether a stock rises or falls. It's about understanding the entire structure surrounding that prediction. And this is only the beginning. In the next episode, we'll follow one options trade from start to finish and see exactly how the contract works.